Hello to everyone. Today I am here with State Bank of Pakistan monetary policy decision on policy rate that is announced today as on March 18, 2024. If you are interested to have update videos on banking and finance related topics, please do subscribe my channel that is Financial Reality. This video is developed with the purpose of knowledge sharing and understanding of the topic. The content of the videos may not focus on regulations and on standards. Here we are going to discuss about the factor influence State Bank of Pakistan, that is the central bank of the country, policy rate decision. The Monetary Policy Committee noted a few key developments since its last meeting, which was held in January, which have implications for the macroeconomic outlook. First one, the latest data continue to depict moderate pickup in economic activity, led by rebound in agriculture output, as Pakistan is agriculture-based country. So there is a significant role of agriculture part. External current account balance is turning out better than anticipated and has helped maintain foreign exchange buffer despite weak financial inflow. It is one of the negative side that is highlighted by the committee. Inflation expectations of the businesses have shown a steady increase since December. Those for the consumer have also inched up in March. On the global front, while the broader trend in the commodity prices remain benign, oil prices has increased, partially reflecting the continued tense situation in the Red Sea. So it is one of the risky area because particularly oil is one of our basic need and having the major or the biggest part of our imports. Uncertainty regarding the inflation outlook. Key central banks in both advanced and emerging economies has continued to maintain a cautious monetary policy strain in the recent meeting. So it's not only Pakistan, but other countries are also having certain issues, and state banks of the many countries are taking care of the cautions while monitoring their monetary policies. Real sector incoming data support the Monetary Policy Committee's earlier expectation of the moderate recovery in the economic activity in 2024, with the real GDP to remain in the range of 2 to 3%. On the other side, agriculture sector remained the key driver after a strong performance of the kharif crop, especially cotton and rice. Prospects for wheat crop also look promising due to increase in the area under the cultivation and the better input condition and the higher output prices. So on the one side, we have major crops that include cotton, rice, wheat. They have seems to be in the good output position. In the industrial sector, large-scale manufacturing depicts a slight decline of 0.5% during July to January, is expected to recover in the coming month due to the improved capacity utilization and the employment condition and favorable base effects. So on the one side, we have the agriculture base, that is a major part of the economy, and industry is also the key driven to the economy of any country. So both showing a favorable future prospects. Other leading indicator point towards the gradual recovery in the service sector. So if we see on one side we have agriculture, on the other side we have manufacturing concern, then third one is the service concern. So all of them showing certain positive indication as their future prospects. External sector, the current account recovered a deficit of $269 million in January 2024. This resulted in a cumulative deficit of 1.1 billion during July to January 2024, which is down by 71% year to year. Improvement largely on to narrowing of the trade deficit, driven by both an increase in the exports and decline in the imports. So here, the think tanks are concentrating to increase the export and to decrease the imports to minimize the trade deficit. That is a positive sign. The exports have risen on the back of the higher food export, whereas import payments have remained subdued due to better domestic agricultural output, moderate domestic demand, and supportive global commodity prices. So we have the support of the global commodity prices. Workers' remittance has been rising consistently on year-to-year basis since October 2023. Financial inflow showed a moderate decline in Jan amidst continuing public debt repayment in the absence of significant official and the private sector inflows. The Monetary Policy Committee assessed that the current account deficit is likely to remain closer to the lower bound of 0.5 to 1.5% of GDP forecast range for financial year 24, which will support the foreign exchange reserve position as well. So here is a mix of the some positivities and some negativities. Fiscal sector, the latest data on the fiscal account show continuing fiscal consolidation. During first half for the financial year 24, the primary surplus improved to 1.7% of GDP from 1.1% in the same period last year. So it's the one of the improvement sign. While the overall fiscal deficit deteriorated to 2.3% of the GDP from 2% in half year for the financial year 23. Here we can compare both years' position. Improvement in the primary surplus to GDP ratio is mainly contributed by the better revenue collection, primarily from the non-tax sources, and relatively continued non-interest expenditure. Sizable increase in the interest payments amidst high debt level and increasing the reliance on costly domestic financing led to an expansion in the overall deficit. So here it's a bit risky or the alarming condition. Monetary Policy Committee emphasized that the continuation of the fiscal consolidation is essential for ensuring the overall macroeconomic and price stability. It is also one of the challenge that we have to meet or we have to face. Inflation outlook. Inflation registered a broad-based and considerably year-to-year decline from 28.3% in Jan to 23.1% in Feb. So it's about 5% plus decline. While the food inflation continued to trend down, core inflation, which had been sticky, also deteriorated to 18.1% in Feb from 20.5% in Jan. So it's about 1.6% decline. The improvement in inflation boldly reflects the combined impact of contractionary monetary policy, fiscal consolidation, better food supplies, moderating global commodity prices, and favorable base effect. Energy inflation also deteriorated on year-to-year basis in February. The adjustment in administrated energy prices has continued to contribute to inflation directly and indirectly. This has implication for needed sustained decline in inflation expectation of both consumer and businesses. So that we have to look. If it is so, it is in the favor of our national key problem that is based on higher inflation. Going forward, any further adjustment in the administrated prices or the fiscal measure that may push prices up pose risk to the near and mid-term inflation outlook. It means there is a risky area as well that need to be sometimes depending on the external factor. Sometimes we have to take certain measures to manage ourselves. In the meeting held on today as on March 18, 2024, in which the committee decided to keep the policy rate unchanged at 22% based on the factors we have discussed. Thank you very much. See you again with the upcoming video on the next policy that is due in April.